Imagine being able to double your covered call returns while only using 25% of the capital that you normally use. You're going to learn how to do just that in this video. I'm Seth Freuberg, and we are one of the top proprietary trading firms in the world with numerous 7- and 8-figure per year traders. You've found the right place to learn. All right, so in today's lesson, we're going to be discovering, first of all, what call options are and how they work. Secondly, how something called covered calls work and how they can be used to extract income from stocks you own, even if the stock you own doesn't issue any dividend at all. And finally, we're going to be showing you how to double the return on your covered call income through a very simple and easy to understand tweak. As I mentioned, one of the strategies traded on our trading desk here at SMB is known as the covered call. And the covered call is a favorite not only of equity traders at prop firms like ours, but also retail options traders and investors all over the world. And one of the reasons investors and traders enjoy trading covered calls is that they create a way to earn income on stocks that don't issue dividends at all, or perhaps issue a very small dividend. The covered call allows you to earn income from investments that would not normally provide income. Now, to understand how covered calls work, we need to make sure that you understand how call options work. And if you're brand new to options trading and you don't know anything about call or put options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for your understanding the covered call strategy, which we're going to be teaching you in this video. Then when you're finished, you can come back and watch the rest of this video. Now, I'd like to remind you that your broker actually will allow you to buy or sell options. And when you're buying an option, obviously you pay cash, and so you're considered long that option. And when you're selling an option, you receive cash, so you're considered to be short that option. Covered calls involve selling call options on stocks that you own and collecting cash for selling those calls to call buyers. What is a covered call exactly? And a covered call is really very simple. A covered call is comprised of 100 shares of stock that you are long, presumably shares you've bought, and one call that you sell at a strike price that usually is at or above the current stock price. That combination, those 100 shares of stock and that short call, typically above the current stock price, that is what is known as a covered call. All right, so there are two possible outcomes of a covered call. The first outcome is when the stock closes below the strike price of the call on the day it expires. And so in that case, if you are the person who has entered into the covered call trade, and if the stock expires at a price below the strike price of the call, then you just pocket that premium. That premium you were paid initially for selling that call, you just pocket that premium. That becomes profit for you. The other case is if the stock closes above the strike price of the call. And in that case, then your 100 shares are automatically sold to the call buyer at the strike price, regardless of how much higher the stock is than the strike price. So those are the two outcomes. You either pocket the premium or you, by the way, keep the premium in the second scenario, but your shares are gone and they've been sold at the price of the strike price that the call buyer has purchased. Back in 2022, you all probably painfully remember what a consistently bearish market that was. Pretty much from the beginning of the year through to the end of the year, the market had sold off down about 20% in 2022. So most people turning the page on 2023 at least considered the possibility that the market was going to have a bounce and rebound in 2023. So let's say that on January 20th of 2023, when the SPY closed at $3.95. All right, let's just say on that day that you went out and bought 100 shares of SPY on that day at $3.95. And at the same time, you went out to an options chain for SPY, which expired about 4 months later in May of 2023. And you went up about 7.5% above the current price of $3.95 to the $4.25 call strike price. And you see that call price there is $5.35. And so you went ahead and sold one of those against your 100 shares of SPY that you bought that same day. So let's see what this means from a cash flow standpoint. And first of all, you bought 100 shares of SPY and you paid $3.95 per share for those. So that is going to cost you $39.05. You also sold the $4.25 May call at a price of $5.35. And of course, each option relates to 100 shares of stock. So you multiply by 100 and you end up with a cash credit of $535 for having sold that $4.25 call, resulting in net cost of $38,965. Let's move to the day that that option expires. And as you can see, the market did in fact rally. It rallied up from that $3.95 original price to $418.62 on the May 20 expiration. And so with the SPY closing at $418.62, let's take a look at the profit on that covered call through that May 20th date. And with SPY closing at $418.62, we can now calculate the profit of the covered call through May 20th, 2023. And let's start with the value of the shares we own. Well, those have now gone up in value to $418.62 per share. So the value of those is obviously $41,862. The $4.25 call, well, that one actually has a zero value on the day that option expires because SPY closed below $4.25. So that right to own SPY shares at $4.25 is obviously worthless because you can go out and buy them in the open market for $418.62. So that call dies, has zero value. And of course, to calculate the profit, you got to subtract out the original cost of the trade, which is $38,965, as we showed you before. So the result is, to date, the covered call is up $2,897. Now, let's say, as many people like to do, that we would like to continue our covered call campaign. So we're going to go out another 4 months, this time to September. We're going to, again, go 7.5% above the current SPY price, which at $418.62, 7.5% above that is approximately $450. So we're going to go to that $450 strike. You can see that the price that day was $3.01. So now let's update our cash flow calculation on the covered call campaign, because now we've added a short call cash inflow coming in from that September $450 call. So again, we paid the $39.05 originally for the shares. We sold the $4.25 call for $5.35. We went over that previously. Now we're bringing in a new $301 for the September $450 call. So now the net cost of our program is actually down to $38,664. It's reduced a little bit further because we got in that $301 for selling that $450 call. All right. So our net cash outflow is $38,664 as of the entering into that September $450 call, which took place in May, immediately after the May call expired. Now we're going to move forward to September of 2023. And as you can see, the SPY continued to rally, and it got to 443.37 by the day of the expiration of this second call that we sold as part of our covered call program. And so with SPY closing at 443.37, we can do a sort of final calculation of the profit of this campaign. And again, the shares are now worth 44,337 because the stock's up to 443.37. You multiply that by 100, you get to 44,337. We subtract out the value of the 425 call, which we mentioned before was zero, but now the September 450 call is also zero. For the same reason, the stock closed below the strike price of the call, so that one goes out worthless also, meaning, and then of course, we subtract out the net cost after having sold both the 425 and the 450 calls. The net cost, as we mentioned earlier, was 38,664. And so you subtract that out of the current value of the shares, and the final trade profit is $5,673, which constitutes a 14.67% return in 9 months, which is very solid. That is a traditional covered call campaign, and most people would be very happy to make 14.67% in 9 months. There's a problem here, right? What if you don't have that initial close to $40,000 in your account? What if you only have $10,000 in your account, right? Are you just out of this trade? Is this campaign out of reach for you? And the answer is no, it is not out of reach for you. If you execute a synthetic covered call, you can get into this game. So let's show you how that works, and let's explain to you what a synthetic covered call is. And the best way we're going to do that is by going back to the very beginning of the year and starting all over again, but this time executing this trade as a synthetic covered call as opposed to a conventional covered call. So again, we're back on January 20th. We're back in time. The SPY has closed at 395, and this time, again, no different than before, we're going to go ahead 7.5% above the market price of 395. So we're going to be up at 425, and we're going to sell that 425 call expiring in May, just like we did before, for the exact same price, obviously, for 535. But this time, instead of buying the 100 shares of SPY like we did simultaneously with the selling of the 425 call in the conventional covered call example, instead of that, we are going to go down the options chain in what options traders call deep in the money, down to 310, and we're going to go very far out in time to January of 2024, so almost exactly a year later. We're going to buy one of those 310 covered calls. So now we're 85 points below where the SPY is trading. Our strike price is 310. And we're out in January of the next year, 12 months later. This option that is 1 year out is known as a leap. It's called a leap option. And that leap call option is deep in the money, meaning it is a strike price that is 85 points. It can be any amount, but very deep in the money, such as 85 points in the money below the 395 price, in this case at 310. That is called a deep in the money leap call. And we are buying that basically 12 months from when it expires. And its price is 101.36. Now you'll see shortly how this concept replaces the conventional covered call. So let's first go through the cash flow so you understand what's happened here. We paid, remember, 101.36 for that leap, that 310 leap in January of 2024. And we paid 101.36 for that. Again, every option price must be multiplied by 100 because each options contract represents 100 shares of stock. So in this case, we pay $10,136 for this 310 call. Remember, we spent $339,005 for the shares, but when we buy this deep in the money call, we're only paying $10,136. Again, we receive $535 for selling that 425 call. We discussed that before. And so when you net it all down, you end up with a net price for entering this synthetic covered call of $9,601. First of all, it's important to notice we have just entered a covered call trade at 25% of the cost of the conventional covered call. The synthetic covered call literally gives you a 75% discount in terms of the amount of capital, the amount of cash outflow from your account that has to take place in order to enter this trade. So that's very important. That means you can mimic the conventional covered call trade with having much, much less in your account, in this case, close to 75% less. Again, we're running through the same trade, but this time we're applying a synthetic covered call to the price action of SPY. So again, on the May expiration, the SPY closed at 418.62 as we discussed. Let's analyze what's happened here. You see, we were short that 425 call, and that's expired worthless for the same reason as it did earlier. It expired well above where the SPY closed on that day, right? But that long option, that 310, that still is in existence and will continue to be in existence for another 8 months until January of 2024. So that hasn't expired, and in fact, its value has significantly increased because a deep in the money call, this deep in the money, its appreciation will be almost as quick as the appreciation of owning the shares themselves. So this deep in the money call has increased to 118.49. Its value is up tremendously from its original value when we bought it. Let's see where we are profit-wise through May on this synthetic covered call campaign. So again, remember, we now start with the only thing that's remaining and alive at this point in the trade, which is that January 2024 310 call. And that one is worth now, having gone up to 118.49, it's now worth $11,849. And the May call, as it did in the previous case, expired worthless, right? We subtract out the original cost of the trade, and so far in the campaign, we're up $2,535. We now, as we did previously, resume the campaign. And that involves going out to September, 4 months later again, up 7.5% from the current price, find the strike price, which is up 7.5%, which is the 450, just like we did before. And just like we did before, we sold this for $3.01. Let's take a look at the current cash flow of the campaign before we look at its conclusion. So remember, we bought that original call for 101.36, so that's $10,136 in cost to us. We subtract out the $535 we received for the May 425 call, and we subtract out the $301 we received for the September 450 call. And when we net it all down, it comes to $9,300 at this point in the campaign. So that is now our effective cash outflow for being involved in this synthetic covered call campaign. The second call, the September call at the 450 strike price, that one again expires worthless in September 2023 because the SPY closed well below that at 443.37. We again have a call that we've sold that has expired with no value, but we still have the long call, which has now 4 more months of life before it expires in January. And as I mentioned earlier, when the call option is this deep in the money, it will appreciate at approximately the same rate as the underlying stock is appreciating. And therefore, in this case, it's way up from the price we paid for it originally. It's up to 138.26 on the same day that that short September 450 call expired. And so we're now in a position to do our final profit calculation of the synthetic covered call campaign as of the expiration of the second covered call on September 15th, 2023. So first off, that 310 January 2024 call, which is still alive until January of 2024, that one's worth 138.26, as we just said. So when you multiply that out, you end up with a value of 13,826 for that long call, which is the only part of this trade which is still alive as of September 15th. The May 425 call expired worthless. The September 450 call also expired worthless, meaning that once we subtract out the net cost of the campaign, which we have seen is $9,300, we end up with a final trade profit of $4,526, which is a 32.73% return in 9 months, more than twice the return on the conventional covered call. So now let's wrap this up by contrasting the conventional covered call with the synthetic covered call. In this example, starting with the covered call, our net cost was $38,798, and our cash profit on the campaign, as you saw, was $5,673, which is an 8-month return of 14.67%, which provides you with an annual return, if you were to annualize it and assume you have the same results for the full year, is 22.05%. Whereas in the case of the synthetic covered call, your cost is less than 25% of the covered call, $93.14. Your cash profit is not that far off from the cash profit you got from the conventional covered call, in this case $44.10. And so with such a great return compared to the tiny amount of capital you had to expend on the synthetic covered call, it's no wonder your 8-month return is 32.73%, which annualized is 49.09%. You can see that the use of the synthetic covered call has essentially turbocharged the returns of a successful conventional covered call campaign. And that's why so many people prefer to use the synthetic covered call, not only because of its terrific returns, but also because it requires just so much less capital. It should be no wonder that a synthetic covered call is a popular strategy among professional options traders. And now you've got the knowledge to apply synthetic covered calls to situations where you might have previously used a conventional covered call.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.